All right, so what we're going to do, there's only a little bit left to Chapter 3. We're going to finish up Chapter 3. We're going to talk about how to do the unadjusted trial balance again, and then we're going to do a lot more journal entries. We're going to do one here on the screen together, which I'll hand out. Somehow I just muted it. Okay, so preparing the unadjusted trial balance. So we already talked about how we look at it. Now look at this trial balance. The very top, if you look at the cash all the way down to retained earnings, what do you see? It's the balance sheet. See how it's marked? That is the balance sheet. And then if you look below that, you have revenue through expenses. That is the income statement. So the trial balance, whether it's the unadjusted, the adjusted, or unadjusted or adjusted, has your financial statements on it. So when we get to Chapter 4, you're going to learn how to do the financial statements from the adjusted trial balance, because you have the balance sheet, you have the income statement, and then if you look really small right here, you have the statement of retained earnings. Here's retained earnings. They actually just don't have any dividends. But once you do the income statement, you can do the statement of retained earnings. So then we take the unadjusted trial balance and we do the posting that we're not going to do in here, all right, but it goes to the T accounts. So that $16,900 goes to our T accounts. And then we did this on the board when you first came into class, but remember the review? This is out here. So some of you guys wrote down what I have on the board. This is the same thing. These are the only 3 ways that you can review cash or receive cash. You either receive it before, and it goes into our lovely deferred, all right, as they're calling it now. It can be at the same time, or you can receive it later, which is our accounts receivable. Anytime you have revenue, or you're making money doing whatever it is you do, you're going to have the revenue account in there. It's either going to be deferred revenue or it's going to be regular revenue, sales or service. So you want to make sure it's in there somewhere. Revenue or deferred revenue is always going to be the credit. So when you get stuck on a problem and you're doing a journal entry and you got paid, it's going to be some type of revenue. Right? If you haven't got paid, it's going to be accounts receivable, but it's still going to be some type of revenue. So that bottom has to be some type of revenue. Doing your homework, you can do the drop down. Then you're going to see deferred, sales, or service. Connect might be picky. Remember how I said I didn't care if you put service or sales? Connect might be picky. So when you get to Chapter 4, it might make you pick between sales and service revenue. Sales is when you're selling an item. If you go to the bookstore, it's sales revenue. If you come here to teaching, it's service revenue. Okay, the difference is you're not selling an item. And then expenses, same thing. You're always going to have the word expense in the top, unless you're doing the second part of the journal entry where you're using it up and paying for it after. But you still have expense in that debit. And expenses are never credited unless you're doing a closing entry. Right? So don't get confused on that. Expenses are debit, 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 except for that one time you're doing the closing entry at the end of the month. So we have another ratio. What was our first ratio we learned in Chapter 1? Or Chapter 2, sorry. Current ratio. And I told you don't forget it, right? What was current ratio? Current assets over current liabilities. All right, so this is the net profit margin. So before I even show it to you, even if you don't know what the ratio is, that's fine. What does it sound like it's going to tell you?
How much you're profiting on.
How much your profit's going to be, all right, of some sort. It has it in there. Current ratio is a little bit more deceiving. I mean, you know you're going to talk about something dealing with current, how you're doing currently. But profit margin tells you what's your profit going to be. It's going to have net income in there because net income is your profit. So your net profit margin is net income divided by your total revenue. And the difference between net income and revenue is your expenses. So basically, profit margin is going to tell you how well are you doing managing your expenses. So your total revenue divided by, your net income divided by your total revenue. So in this example, we have $12,000 in revenue, and we have a roughly 9,000 something in expenses. So let's pull it up. 8,900. I was close. So our net income is $3,100. Our total revenue was $12,000, so our profit margin is 25%, almost 26. What do you think? Is that good? No? Now remember, what type of business is this?
Sales and service, both?
It's sales, kind of. And we're making something, but we're making something inside. So it's kind of a weird company, right? It's more of a service. We're developing software, games, right? So 26%. How do we know if that's a good profit margin?
Compared to other companies?
We got to compare it to other companies. Ratios are awesome because you can compare them to other companies. Otherwise, you can't compare. This is a brand new company that made $12,000 in revenue. Can they compare themselves to EA Electronic Arts if you're not a gamer? That's like Madden and 2K basketball is getting ready to drop. Yeah, we pre-ordered it. Okay, so you can't compare it to that. They're millions. All right, I'm guessing, but they're millions. But how do you know if you're doing well as a startup company compared to a big existing company? You compare your ratio. Is this good? I'd take it. Now that's your profit margin. It doesn't take into account some other things, but that's your profit margin. That's a pretty good profit margin. All right. When you look at companies like Home Depot and some of them, their profit margin's really slim. When you sell an item, it's harder. When you sell a service, your profit margin's usually high, assuming you're in a profit company. Like education, public education is not for profit. We're not in it to make money. We're supposed to spend what we make. When you go to private schools, they're in it for a profit, so that's why you pay a higher tuition. They're trying to make money. All right, so what are some of the limitations of the income statement? And these are important because, and I actually have an email from an online student asking me a question that we talked about last week. And the question was about the balance sheet. And remember the PowerPoint slide? I know they didn't look at them. That talked about what statements do you use based on what the investor wants? And their question was about which statement the investors use based on what they're trying to use. And investors want to know when they're going to get their money returned to them. And what statement did that tell? It was a it was a statement of retained earnings because they're looking at their dividends coming back and they're looking at the income statement for their revenue return, not the balance sheet. That's going to be a creditor because they want their money paid back to them. All right. So they were looking at that. So what's the limitations of the income statement? Number one, the income statement is not cash. That's the most deceiving thing on it. Could you have a gigantic net income and no money? Yes. And that's a problem because your accounts receivable could be huge. The very first problem we did was accounts receivable, and we didn't know we said revenue. So you could recognize revenue, 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 revenue. But if you never collect it, your company is not doing good. All right? And net income doesn't equal the value of your company. That's not stockholders' equity. So we don't know what's worth. And net income is not exact because we use accrual-based accounting. We recognize revenue when we earn it, not when we get the money. Right? So the Cardinals are recognizing their revenue next April, and next May, and next June. Not now. So right now, we don't know how much money we're making because we're going to recognize it when the Cardinals, well, that's when season tickets start, when the Cardinals start earning it. So we don't know right now how we're doing. So it's not exact. All right, so now let me switch slides here. Go to these. All right, so I'm going to hand these out. These are more, I think I gave you one to me. This is another problem, but we're going to walk through it. The first step we're going to do, and you can flip it over, you can see them on the board so you don't have to keep flipping back and forth. This is just doing journal entries for revenue. So you want to start, you flip it over, there's plenty of room to do the work on the next page. A, B, C, D, E, F, there's 5 journal entries. You are answering as if you are in October, all right? And you're answering from Sync's point of view, all right? So a customer paid $20 cash for 15 songs from Sync's eTones. So what is the journal entry that Sync is going to record? If somebody bought and paid for 20 songs with cash, or $20 per 15 songs. So you're gonna do that for each. There's gonna be 6 journal entries. And I'll leave that there so that you don't have to flip if you don't want to. All right, let's take a look. All right, so we're looking at this from the standpoint of sync. So let's take a look at the first one. The first one said that a customer paid $20 for 15 songs. So what are we going to do for the journal entry on this one? Liza? We received cash.
And we earn revenue.
And-
But how will we know that they download the songs or not?
We don't. If they paid the cash for the songs, it is revenue. Now, if they choose not to download it, it's kind of like a gift card. Except for a gift card you're buying for the purpose. Download, they paid to download it. So you would assume that they downloaded it at the time they downloaded it. Right.
So you say service revenue or
This would be this would be actually because they're selling an item. This one's kind of iffy because it's actually a product. So a song is actually, it would be sales. A song would be sales because they're not providing a service. All right, so revenues, they give a little bit of explanation here. So it is something that's going to be downloaded. Oh, sorry. So what's going to be the journal entry? You said it's going to be a debit to cash and a credit to revenue. I thought they listed that on here, but they don't. Okay. So then Comfort Depot provided installation of carpet for $2,600. Comparable installation, other companies cost how much? $3,100. So what are we going to do here? Cash of $2,600. Does it matter that the other companies did $3,100? No, you just got a good deal. And then we're going to credit revenue. All right. Now, you look confused. Why?
Yeah, because who are we recording transaction for? Which company? I mean, Comfort Depot or?
That's a great question. Okay, so look at this. It said you are supposed to look at it from the standpoint that you are who? On this one, it said Comfort installed it compared to other provided. So go back. What did this say, right? Okay, I gotta go back too many. There. All right. The following transaction for many businesses from the point of delivery. So now we're not. This one was answer from Sinks. Now we're at Comfort. Provided Comfort into. So we're doing the installation that's coming to us. So we did the installation. So it's revenue. So they just want to know. The first one was Sync. So is it revenue? A service has been provided. So we're not looking at it from Sync's point of view now. It's just Comfort's point of view. Okay. How about the next one?
Excuse me.
Yeah.
I thought it's the company just gives a service to put a copy, but not receive cash yet.
They got the cash for $2,600. They provided carpet installation for $2,600.
Gosh.
Cash.
Did the work, then
They did the work and they got the installation.
So the cash is debit here.
Cash was debit and
service revenue.
service revenue. Yep. And actually, could be sales too because carpet was installed. So they provided carpet. They're going to have a cost of goods sold, the company that did the work. All right, Ignite Company is scheduled to install digital cable at 600 homes next week. The installation is $120 per home. The terms require payment within 45 days. No journal entry? Why not?
Because nothing has happened.
Right. Nothing's happened, and nobody paid anything yet, right? Now, what are they going to have to do? They're going to have to pay $120 within 45 days, but nobody's paid anything. Only promises. All right, Ignite completed the installation of the digital cable. Now what do we have? Cash and
The
deferred revenue? Because did they do the work?
yeah.
Well, what did this say back here?
Accounts receivable.
Okay, well, exactly. Is it cash or is it accounts receivable?
Accounts receivable.
Right, it's going to be accounts receivable because payment's going to be within 45 days. So it's not cash. It's accounts receivable. They're going to charge $120 per home, and they're going to do it next week. So it says they completed the installations. So it is accounts receivable. Is it deferred revenue or is it revenue?
Service revenue.
It is service revenue, all right? Because they did the installations. It said completed the installations of the work. So accounts receivable and revenue. They fulfilled the obligation. And then the dollar amount is 72,000 because they said it was 600 homes at 500 homes? At 120. Yeah. All right, Ignite received payment now. They received payment of that 72,000. Cash and accounts receivable, which obviously if you got the one before that wrong, you're going to miss this one. So how I grade that on a test depends on how you answered this question. So if you, for some reason, put accounts payable on this question, but you did the journal entry right for accounts payable, you might get this one right. Unfortunately, if you get this the one before this completely wrong, then you're going to miss both. But if you answered this question right based on how you did the other question, you would get them both right. If you answered them based on that one. Yeah.
What was the credit for that?
The credit is accounts receivable. So it's going to be debit to cash, credit to accounts receivable. All right, so there's no revenue recognized, but you are going to do that journal entry. Oops, I just showed you the answer before I went. Okay, a customer purchased a ticket from Cooper Airlines in October for $600 cash to travel in December. Cash and deferred revenue. So no revenue is going to be recognized in October. And that's a lot for airlines. You know, in our examples, I kept giving you like Cardinal tickets and concert tickets. Airlines do it all the time. The only way airlines recognize it immediately is if you buy a ticket to travel in that month. All right. So was that hard or not so bad? It was medium. All right, let's take a look at the expenses now. Expenses, just flip it over. And so what they want you to do is recognize or say whether or not expenses occurred. I want you to do the journal entries again, though, because the journal entries go along with recognizing an expense. So 6 questions. Did an expense happen, and what is the journal entry? And again, the journal entries are probably going to be on the board. And also, if you can't come up with the account, do the dollar amount. All right, let's take a look. So here we're looking at different activities with expenses, and they're all kind of individual, just like our revenues were. And we're going to look at, are they expenses, and then we're going to add the journal entries. So Levino paid its computer service technicians $88,500 in salary for work done in January. So is this going to be an expense in January? Yes. So what's the journal entry?
Wages payable.
And cash. All right, wages expense, salary expense, either one of those, and cash. All right, the $88,500. So the dollar amount was just the full dollar amount. That's the easiest wages one you can do. At the beginning of January, Potter paid $3,500 in rent for February through April. So is that an expense in January?
Prepaid?
Well, first answer, is it an expense in January?
Yeah, because it's prepaid.
It's prepaid, but is it an expense?
No, because it's not applied to January. It's
Right, this is the, right here, it's prepaid. All right, now one of the things you'll see in your book I'm not a fan of, it will say prepaid expenses. I don't like that because it confuses you guys that it's an expense. It's prepaid. In this example, it's prepaid rent. They paid it, and so the journal entry is actually going to be prepaid rent and cash, but it's not an expense. When will it start being an expense?
February.
February, March, and April, which in Chapter 4 we're going to show how to do that, yeah.
So we won't record that unless it was like February?
Well, we'll record it. We're going to do a journal entry in January. The journal entry is going to be to debit, prepaid rent, and credit cash.
Okay.
And it's going to be an asset. It'll be an asset because technically we could get our money back.
Yeah.
Technically.
So sometimes it gets confusing, like we are recording with water company
Right.
or we are recording with someone else's point of view. Like
Right.
at the beginning of January.
You are Potter Company. That's what they're, each one of these is individual, and you are Potter Company. Potter Company paid rent. You paid the rent. What's the journal entry?
So cash is credit and
Prepaid rent is the debit. Okay, so Wiley Publishers used $36.50 of electricity in January. They have not paid it.
Said no.
I said no journal.
No journal entry, but they used electricity.
yes. So it's an
But
expense
It's an expense.
and accounts payable.
and accounts payable. Okay? What are we using right now? If I come over here and I do this, I turned out the lights. Technically, we're not using it, but now we are. When is the college going to pay this electricity bill? Next month. They're not going, even though it's early September, they're going to get the bill for electricity towards the end of the month. They're going to pay it in October. So most companies have this. So that $36.50 of electricity is this month. So yes, they used it up. It's going to be a debit to electricity expense or some type of utility expense and a credit to accounts payable. All right, William Smith Company received and paid in January an invoice of $18.50 from a consulting firm for services received in January. All right, so everything happened in January. So they received and paid an invoice. So that means
Accounts payable?
well, they received an invoice for services in January.
I said,
Service expense?
yeah, I said consulting.
Consulting expense
And then cash.
and cash, so they paid it, so that's cash, we know that. So if you were doing a journal entry on the test, you would credit cash for sure because you know you paid it. And it sounds like there was some type of consulting expense or whatever, because they didn't do the work, they paid someone to come do the work. All right, so some type of an expense. All right, services received in January. So they did not do, it was some type of work that they had done. The campus bookstore received consulting services of $48.90. The terms indicated that payment is due. And so now the campus bookstore received consulting services, and they're going to pay it next month.
Service expense and accounts payable.
Service expense and accounts payable. So yes, they received it. So the word received means it happened. Received, used, generate, all those are the same thing. All right, Cooper's Incorporated had its delivery van repaired for $3,200 and charged the amount. Repair expense.
And accounts payable.
Yep, repair expense and accounts payable. All right, so those were a little bit harder, depending on how you looked at it, because what I liked about those problems was they brought in a whole bunch of different companies. It wasn't the same company, so it made you kind of switch the way you were thinking. Okay, that's why I kind of did that. All right.